Hello, good evening, and wishing everyone a warm welcome to our ETF series, Let's Talk ETFs. I'm Zahra Jehangirji from the product team at Kotak Securities, and with me we have Lakshmi Iyer joining in. Uh, we'd like to have Lakshmi as well in the room, please.
Hi,
Hi,
Zahra.
Lakshmi. Good evening. So, just to give everyone an introduction, Lakshmi is with Kotak Asset Management Company since the past 20 years. And we'd like to have her talk to us today. Hello. Yes, I hope I'm audible now, Lakshmi.
Now you are, yes.
Okay, great. I think I sort of missed your introduction, so I'll introduce you again. Lakshmi has been with Kotak Asset Management Company since the past 20 years, and she is the Chief Investment Officer over there. And she has done her MBA in Finance from Narsimonji Institute of Financial Management. And she is with us today in the capacity of walking us through broad based indices. Uh, Great. So, should we start, Lakshmi?
Absolutely. Ready to go, Zahra.
Great. Okay. So, Lakshmi, we had one round last week with Nilesh who explained the basics of ETFs to us. Today, we want to deep dive into how we can diversify our portfolios with broad-based indices, broad-based index ETFs. So, do you think you could walk us through, and in very simple terms, what exactly are broad-based index ETFs?
Yeah, thanks, Zara, and hi, a very good evening to each one of you. This topic is a very, very interesting and a personal, topic which I love driving through various means and platforms. Onto your question, Zara, broad basing. What do you mean by when I say broad and when I say narrow? Narrow means it's very restricted. There is very limited scope, and broad means it encompasses multiple things, and the base is slightly wider. So that's how broad is quite synonymous with wide, and that's exactly what broad basing of ETFs mean in this context. What we are talking about broad basing effectively means these ETFs or these indices that you will be investing will be basis the value of the company. That could be a small value, it could be slightly higher, and it could be very, very high. And that broad basing is achieved through something known as capitalization, which is getting to know what is the value, and therefore the market capitalization way of investing is one of the ways to broad base your entire investments in such a manner that you actually achieve the much needed diversification. So that's in a nutshell what broad basing is all about.
Okay. So, when you said that it depends on the size of the company also, right? So, we're talking about market capitalization of a company then,
Yeah,
right?
that's correct.
So,
That is correct.
maybe in one line, you can explain what exactly market capitalization is to everyone who's new to the markets.
Yeah, so market capitalization in plain and simple terms is nothing but the value of the company, which is every company has some stocks which are outstanding, shares which are outstanding, and which is what we all buy, sell, trade, etc. Now, the total number of shares multiplied by the price of that share today is what the value of the company is. And that
Okay.
company value in number terms is what is called market capitalization. So market cap, as they
Okay.
call it, market capitalization is basically the same thing.
Okay. So, when we say the likes of Reliance, Larsen and Toubro, and maybe Asian Paints, they're the large cap, market capitalized scripts, right?
That is correct. That is correct. So, for example, there will be a threshold. So, there are over three and a half, 4,000 stocks which are listed on the stock exchange. How do you decide what is the market cap? Like, there are three broad categorization, or categories of capitalization. And yeah, the stocks that you mentioned actually comes into the large cap bucket.
Great, thanks. So, is that how the regulator also decides how an index should be broken up into large, medium, and small size
Yeah, so
companies,
basically,
right?
yeah, that's right. So there is a large cap, as you rightly alluded. So the largest company by value today in India, and hold your breath, it's a little about 17 lakh crores, and that company is Reliance, which belongs to the ONGC, oil and gas sector. So
Segment.
the number one stock to the number 100 stock is, as per the regulatory or SEBI definition, comes or qualifies as a large cap. So the number one stock, as I said, is about 17 lakh odd crores. The 100th stock will be close to about 47, 48,000 crores. That's close to about 6 odd billion dollars. So up to that threshold, 100 stock is actually your large cap universe by the definition. Then the 101st stock to the 250th stock, so anything below 48 or 1,000 crores to up to the 250th stock, which in value is close to about $2 billion. So broadly, from which is 16,000 crores. So about 2 billion to $8 billion will actually be the mid market or the mid cap stocks. And anything below that, which is the 251st and beyond, will actually be the small cap. In fact, Zara, there's one more category which is not very, very well researched, very, very well held also. It's called micro caps. That will be way, way below the pecking order. But I think from a broad basing standpoint, these are the three market capitalizations which are very, very popular and very prevalent as we speak.
Okay. Thank you so much, Lakshmi, for that. Moving on, could you give us a brief on when we say broad-based index, ETFs, are we talking about a mixture of all these three different capitalizations into one ETF? Like, does an ETF constitute of three different sizes of companies? How does that work?
Well, the answer is yes and no. Why I say no, I'll go to the no first, because it's quite difficult if you want to own all the market caps into one ETF. It's quite cumbersome because as I explained to you, 100 stocks are just in the large cap, then up to 250 stocks also sit in the mid cap, and another 250, 300 stocks actually go into the small cap. So having such a big universe of securities is a Herculean task, and therefore there are each of these capitalization based indices on which there are exchange traded funds or ETFs. So, for example, there is a dedicated large cap, for example, ETF. There is a dedicated mid cap, and of course, a small cap. So, in that, also, what you get is broad basing.
Okay. Thank you for that, Lakshmi. So, if you can give me maybe an example of one of the broad-based index ETFs, uh, just for everyone's understanding, maybe a couple of names that come to your mind.
No, absolutely. I think the most popular and tracked index today, not just in India or I would say worldwide, is the front line. What really comes top of the mind is actually the Nifty 50 and say the BSE Sensex. So these are effectively comprising the top 50 stocks in the country, which is Nifty 50, and then there is a Sensex, which is the BSE 30 stocks, so the top 30 stocks in the country. Now, these are prominent examples of having a large cap index. So, as I said, anything which comes under top 100, there are also top 100 ETFs, but not so very, very popular. So I think Nifty 50 and BSC or the Sensex 30 are the two most popular ownership perspective ETFs that I can think of. On the mid cap space, Again, there isn't too much of varieties to choose from, but there is again a mid cap index, which is a mid cap 100 index that is available from a market standpoint. Some of them also offer a mid cap 150. So so between 100 to 150, you again have an index offering. Similarly, you also have a small cap index, which again, on which basis which you have an ETF. Uh, in our observation, in terms of scanning through the marketplace, the most popularly launched ETFs are largely on the large cap index, and subsequently on the mid cap. That's lot to go do with the way you can buy these stocks in the index, replicate them, trade them, all of them. And from a liquidity perspective, these two categories are the most popular ETF offerings in the marketplace today.
Would it be wise to say that the returns on the large cap ones are higher?
Not really. I gave you the example of what is the value or the market cap of the largest stock in the large
Right.
cap index, and I also gave you an example of how the smallest value company in that large cap the size is. So what happens is
Correct.
these are mammoth. The name is large cap, right? So for them to consistently grow year on year compared to say a mid market or a mid cap may not necessarily be always possible. I mean, consistently is what I mean. So there, typically we have seen, of course, a couple of years here there, I'm not talking about it, but usually we have seen over longer terms the tendency of mid cap companies and mid cap stocks to outperform over a longer period is quite high. That's how the small becomes a mid cap, the mid cap becomes a large cap,
It's a
right?
large
Because
cap.
they keep
Right.
growing. Yeah,
Absolutely.
they keep growing. So the growth
Okay.
potential is clearly there in the mid cap index or stocks over longer periods of time. But yes, in very short intermittent volatile times, I think it is the elephant or the mighty king that which comes to the rescue. So yeah, that's where large caps act as a safe haven.
Okay, great. Thank you, Lakshmi. What about if I was to ask you, what would a retail investor do? Should he be uh, investing in these without fully understanding? Is it safe to invest in them when he fully doesn't understand in ETFs? Could you give us a sort of background around that?
So, in fact, Zara, my view has always been that if you are not a DIY, for example, if you ask me to buy and assemble a furniture piece from IKEA, I'll go completely bonkers. And some of my friends have that similar feeling about stock markets, which I have about furniture. So, for anyone who has similar kind of feelings, I think ETFs are the go-to place. Because they already
Correct.
assort and assemble everything and give it to you on the platter. You just have to click the button and go ahead and buy or sell and do whatever you want. So I think it's as simple as that. You just need to have your risk appetite because you are investing whichever capitalization you decide to choose. What you are investing is actually in the equities market, which is actually meant for the long term, not really for the short term. So I think keep that risk appetite in mind. You don't need to know the history, geography, janam kundli of every stock that you are buying in that basket. And that is the reason it is highly, highly suitable for the non DIY or do it yourself person.
Perfect. Thanks, Lakshmi. That was just the perfect example of how confusing the market is to a lot of retail investors. So whereas you've explained what the upsides are and how easy it is for somebody, could you list maybe a couple of downsides or disadvantages of having these as part of your portfolio?
Disadvantages, you mean, of owning these ETFs?
Yes.
So
And
I
it
would
could be
say
in terms
the
of a
biggest
cost.
Yeah. So cost is of course there in every the way you're buying stocks, you're buying ETFs. So that's a common factor. So I don't really call that as a disadvantage. Um, I really don't know if I should put it in the category of disadvantage, but clearly equities when you are owning, whether it is in a fund route, ETF route, or direct stock route, it is vulnerable to daily ups and downs. You cannot say, oh, I have bought the basket, so I'm relatively safe. Yes, you are relatively safe on the pros and cons because you get the benefit of owning the entire plethora. So if one stock is pulling down, there might be some other stock which is pulling up, and on balance you're doing good. So owning the market in times of uncertainty, so the top 50 stocks or the top 100 stocks are pretty much the representation of almost all the sectors which are available in the country today. So I think that's the biggest thing. But keep in mind, as you might be a first time investor, you might be an intermediate investor, or you could be a very arrived investor. I think arrived investor knows it all. They've paid enough and more guru dakshina to the markets, but to realize that in the near term those fluctuations can unnerve you, whether it's ETFs or whether it's buying direct stocks.
Absolutely, absolutely right. And so let's assume that today I'm an investor who's only invested in mutual funds till date. How do you think I could use these type of ETFs to balance out my portfolio? Or maybe you can give us an example of a mutual fund that I have already invested in, which has a 50-50 equity to debt ratio. How would I handle, what should I be doing next with these type of ETFs?
No, so let's go with your example of say 50-50 equity and debt. In that 50% equity that you have, there is a case to own at least 15 to 20% of ETFs. So 20% of that 50% is approximately 10%. So on a total portfolio, if you were to recalibrate, it would be 40% of say mutual fund equities, 10% of ETF equities, and then the remainder 50% remains in fixed income. Now, I'll tell you what the advantages are. A, you are getting to own the market. When you are buying mutual funds, you are buying a basket of stocks 30, 40, 70, 80, depending on what the fund house view is, which means it's actively managed. So that's definitely important because that helps in creating that extra return over and above what the index is giving or what the market is giving. But there is also that element of uncertainty for which you need to have an insurance or a hedge, and that hedge is your market or the index ownership. So out of your total equity allocation, carve out at least 10 to 20% of that into ETFs to just own the market, and that helps you have a certain degree of certainty or a higher degree of certainty when you're actually charting out your risk return potential. So definitely there is a case for complementing ETFs alongside your equity mutual funds for sure.
Okay, great. Thanks, Lakshmi. So when we talk about these type of ETFs, when you read online jargon about core, satellite, tactical ones, what's your view on those? What's perfect for which type of investor?
So I'll go for the easiest one first, tactical. Now, tactical means hawa ka jhoka. Just to give you, you get swayed with the wind, which means, oh, today, you are of the view that suddenly there is going to be some regulation changes, and you see suddenly pharma looks very good. You go and buy some ETF or which is got only pharma stocks. Or suddenly you think that, oh, interest rates. Are going up so the lending book of the banks have started looking attractive, so banking will do well, for example. Then you start buying stock ETFs which have banking as a higher exposure. So these are the tactical views. If you go into core allocation, which is what is very very important from a long term wealth creation perspective, that you need to stick to a combination of say large cap plus mid cap, which is called say flexi cap, as a case in point, where there is the flexibility to own each of these market caps as part of your portfolio, Or as I said, you buy, if you're going the ETF route, you actually buy them but have a predominant overbearing of a large cap plus a small tadka, as I would say, of mid cap to create your core portfolio. And then satellite are ones which come associated with them. There could be some add-ons that you would like to see as part of your portfolio, that is called the extended core portfolio or the satellite portfolio. So that will kind of sum up and give you the wholesome portfolio offering. Tactical calls are best left to expert judgment. You can't be taking views the way you toss a coin. It's not going to be that simplistic. If you are very well informed, go for it. If you are not, just stick to your core and satellite. I think they will be your man Friday or woman Friday, as we call it. And yeah, it's today's a Friday, so all the more relevant.
Perfect. Okay, so I'd like to open the forum actually for questions. But before we start the questions, Lakshmi, I just wanted to understand from you if today I don't want to really go deep dive into, researching which ETFs. In the last session, Nilesh mentioned that I have to look at ETFs uh, um, with the lowest
Tracking error.
tracking error. Yes, my bad.
Yep.
So, would that be the same advice you'd give for these ETFs as well?
So all ETFs mirror the index. So when you're mirroring the index, sometimes you walk forward, sometimes you walk backward. It's like, you walking with your colleague or your partner or your friend for morning walks. You can't be walking matching, but you start on time and broadly end on time. So that's in a nutshell what tracking error is. How much are you deviating from the index? So yeah, most common used yardstick of evaluating these ETFs is how closer you are to the index or how low is your tracking error. So yes, please follow that. That's an important rule, one of the important rules, I would say, when you are evaluating for ETFs investing.
Okay. And how exactly is it that when an index is reconstituted, how is an ETF rebalanced? Could you give us maybe one minute to explain exactly how that's done?
Yeah, so I know what's coming out of the index, I know what's going into the index, right? So something, one stock comes out, one stock goes in. Now that stock in out going is known to you as a market participant at least a month in advance. Based on that, you
Okay.
don't take a decision, but 2 or 3 days before the actual date, which is the D date as we call it, of the rebalancing, the index provider actually sends you the weightages. 3% of stock A goes out, 2.7% of stock B moves in, and say zero point 0.3 or whatever of stock C moves in. So what I do is, as a money manager, I actually end up selling that stock the moment I have that information, and the moment the monies are there, because selling, you get the money, and the moment you
Takes
get the
time.
money, you do a buy purchase of the incoming stock. So it's a pretty seamless transition into the new or the newly constituted index. Most of the times index reconstitution happens like once a quarter. Maybe some of the indexes it could be half yearly, but this is the process which is being seamlessly followed.
Okay, great. So I've opened the forum for questions. The first question is, which broad-based indices would you recommend to invest in given the current market conditions?
So right now, given the wobbly nature of the market, given the kind of unsettling global, I would say, headwinds that we are also as a country are being faced with, it would be prudent to do a large cap index bias right now. And yes, if you do really fancy to have mid cap, it's nothing wrong to do that right now, but do a staggered investment into the mid cap, given that if the volatility unfolds itself into some more turbulence, the large cap tends to have a higher cushion, higher weight, difficult to shake. that kind of a thing. Lower weight
Absolutely.
हवा से फूक जाता है, so something similar to that. So try to do a staggered way of deploying money in the mid cap in the current market scenario, but large cap you can still go pretty lump sum. That's not a problem.
Great. So, the second question is what are the factors and parameters that you use to decide which ETF to purchase while choosing your ETF? Would you say that's tracking error, the lowest tracking error?
Lowest tracking error, definitely one, but I think the overarching part of the discussion has to be around how much of risk appetite you can fathom. So that is one of that's an individual parameter over and above the fund parameters. But yes, for the fund parameter, even the liquidity that is available on the stock exchange for these ETFs are something which you should watch out for. Is your buying selling going to create more volatility in that particular unit? I think these are some of the watch factors, which I would say I would urge all the viewers to actually engage with your broker, who would give you, for example, if you are with Kotak Securities, they will actually give you because they're tracking that market on a live basis. Of course, you can track it yourself as well, but engage with your broker. I think that will be very, very useful.
Okay. Someone's even asked how much return can an investor expect in the long run while investing in different market cap indices. So, would you
So
be able to give us
typically,
a
as I
range?
said, yeah. So as I said, of course, the future predictability is as difficult as today. The weather forecast, for example, in Mumbai, it is only gray skies, and yesterday it was a nice yellow sky, or a bright day, I would say. So I would say that going forward, assumption, broad brush assumption is that if the country, in this case India, is slated to grow anywhere ballpark region of 6 to 8%, and you have at least a steady state 5% kind of an inflation. So you add that to your potential growth. So 12 to 13% compounded is the potential that a large cap universe can deliver over longer periods. And we've seen that also, the past data also. If you look at, say, a Nifty ETF, in the last 5 years would have given roughly about 12 to 13% compounded returns. So I think that's one broad brush to really look at. If you look at the mid cap, as I said, the tendency of mid caps to do better in a market scenario where the outlook is growth oriented, the tendency of mid caps to outperform the large caps over the 5 to 10 year kind of an investment horizon is pretty high. For example, in the last, I think 3 to 4 years, the compounded mid cap, top 100, stocks would have delivered roughly about 25% compounded return. So I think that's a broad brush, estimate when you're actually planning investments in across market capitalizations.
Perfect. And if I was, this is actually something I'm asking, if I was to create a basket of ETFs from a longer term perspective, say 20 years, what mix would you ideally make for me? Would you
So I would
recommend?
go with the large cap, mid cap, as I said, Zara. I would go with the large cap, mid
Okay,
cap combo. I would probably have about 60% odd in a large cap and about 40% odd in mid caps. Because for me, as I said, it's I'm a very old fashioned investor. If I take my own personal example, I'm more like a fill it, shut it, and forget it. Then I don't really bother to churn portfolios. So in that
okay,
sense, I am like Kumbhakaran when it comes to investing. Just buy and doze off, and let the money work for you in the market, because if you work too much to make money, you end up getting hyper. So for me, that mix works. There is no one size fits all, of course. Some people are prefer more than 80% in mid caps. There's nothing wrong about it, but please assess your risk appetite, assess your income generating potential before you take such decisions, because there is no one size fits all.
absolutely. Thank you so much, Lakshmi. I'd like to end today's discussion on this note. Thank you so much to everyone who's joined in and made this Friday evening so enlightening. And I hope everyone who has come here has learned something. Thank you, Lakshmi, for your time. And in case anyone's wondering how they should be investing in ETFs through Kotak Securities, you need to open an account, you need to download the app, You need to go to the more section and click on ETFs to read more about it and make your choice. Thank you, Lakshmi, and thank you, everybody.
All right. Take care. Have a great weekend. Bye. See you.
You too. Bye bye.